Good morning, everyone. It's my great pleasure to invite you to NCER and IIC's mid-year review of the economy. I understand it has been a long-standing practice to do this event around this time of the year when half the fiscal year has passed by. This year, a couple of things are different in what we are going to present. First, it's a brand new team under the brand name of course, NCER. So Dr. Mridul Saggar, who was until very recently an executive director and a member of the MPC at the RBI, is a co-author or co-presenter of this analysis along with me. So the team is new. Another thing is that we have a stellar panel here today to talk about the economy and everything else that you might be interested in through the Q&A. So I'm particularly pleased and delighted that Professor Panagariya, Mr. Amitabh Kant, and Dr. Anant Nageswaran accepted our invitation to be here today. The way we have structured the presentation is that Dr. Panagariya will chair the event. Dr. Mridul Saggar will provide the global outlook. I'll go on to provide the outlook for the Indian economy. And then the panelist will come and speak as guided by Professor Arvind Panagariya. So thank you again. Over to you, Professor Panagariya.
Okay, so I think Mr. Kant has to leave a little early, so we'll begin right away. I think we'll have Mridul Saggar first do the presentation on the global aspects of the macro developments, and then I think we'll have Poonam speak on the scene where India stands, and then we'll have the panel with Mr. Kant leading us. So that'll be the plan. Let's begin. Mridul?
Thank you, Professor Panagariya, and let me also start by thanking all the co-panelists here for joining in this important discussion. I'll briefly try to capture the global backdrop in the current juncture, because assessing global economy is important for the forward-looking assessment of the Indian economy, because we are living in a globalized world and we can't be decoupled. So while it is true that net exports traditionally contribute rather a drag on the Indian growth, but given that we run a negative trade balance that's natural, what is important and often missed is that India's exports and imports of goods and services are 46.4% of GDP if last year's data is to be seen. And this number is higher than that for the United States by 4 percentage points. So we are as globalized as anybody, just we have a large domestic economy is a different issue. And we need to be cautious about how global growth might affect us, because global growth is losing its combustion due to 5 main reasons in my assessment. I'm not saying that if global growth falls or goes into recession, India is going down, India would actually stand out. And that's what I think you were there at the Global Policy Agenda meeting at the IMF, and the IMF MD very clearly said that India is a bright spot in the darkening horizon, and that basically the reforms have put us in good stead and the growth is pretty much strong. But global growth is losing its combustion because, one, there has been sudden surge in inflation across globe from 2021, and it has eroded real incomes of the people. Second, synchronous monetary policy tightening in 2022 has started to affect demand. Third, some of the pent-up demand that the global revenge buying brought in also now is waning. Fourth, supply side remains impacted by the pandemic. IMF's assessment of the scarring of the pandemic, the medium-term losses is sizable. It's 5.3% of the GDP. Asia and Pacific region, it's 9%, while freight container shortages still affect the output levels, though it has come down substantially from its peak. But there have been dislocations. And lastly, the war in Ukraine and the consequent rise in global fragmentation has had some effect on the supply chains, but more importantly, it's affecting the business and consumer confidence, and that is where the risks really come in. So let me just run you down through how the projections are. And clearly, as you see, IMF expects the growth to slow down from 6% in 2021 to 3.2% this year and further to 2.7% next year. And the slowdown is pervasive among A's and EMDs. The other forecasts are also similar. So ballpark, if you see where the consensus today is, and our conjectural estimates are similar to that, we expect the global growth to fall roughly to 3% or underneath that this year, and probably to 2%. The 2% would occur only if we have the scenario of very significant global fragmentation, which we think is a plausible thing because the way the geopolitics is taking shape, next year we could see significant strifes coming in. So let me just also point out
If I may, Dr. Saggar, are all of these at PPP aggregation, or are some market and some PPP?
So this is not at PPP aggregation. This is at market GDP, dollar GDP aggregation. On PPP, we will be still better off. I mean, I think that's current price. So global commodity price inflation has fallen quite a lot in recent period, but I think the rates are still elevated. What is significant is that while precious metals and minerals have fallen, energy, fertilizer, food prices are still very high. And one has to wait and see when the global inflation falls. It will probably be more into the second half next year, but we need to see. This is how stagflation risks are currently coming to the fore, because inflation has surged to 26-year high, catching central banks behind the curve. There has been an enormous rise in inflation rates across various jurisdictions, whether they are advanced economies or whether they are emerging markets. The figures in parenthesis give you the latest inflation numbers against each country at the bottom of it. And this clearly shows that inflation is maybe still 4 times higher than the targets in advanced economies. UK 5 times higher, Euro area also 5 times higher. They are little better off because our emerging market targets are higher, but everyone is affected. Aggressive synchronous monetary policy tightening has been has been pretty significant, and we see basically, as you see, central banks across the countries have sort of hiked. This month itself, in the start, the Federal Reserve, the FOMC raised it by 75 basis points, and UK also raised it. Bank of England also raised it by 75 basis points. Cumulatively, we are seeing very large increases in the policy rates, which we have seldom seen in the cycle. Now, emerging markets also, if you see, this has been a very significant hikes. Hungary, like 12.4% increase in policy rate, Brazil 11.7%. Compared to that, we have lived with just 1.9% increase in our policy rates, which is small. Also because inflation, the nature of inflation in India is a little different, and there was this growth inflation trade-off which was coming in the mind. I think another thing I want to really point out is among the global risk is the public debt levels. And the public debt levels are phenomenally high across countries. China is exploding, and China debt levels have doubled since the global financial crisis and are now going to cross 100% by 2027. So among emerging markets, of course, India also has high debt levels, Brazil has high debt levels. Also, advanced economies' debt levels are very high. We could see some of the debt bubbles exploding into 2023, more in the emerging markets where financing suddenly stops. So these are some of the risks, but all said and done, I think we are capable, we have the buffers to handle the spillovers, and that is the reason why we think India could still outshine with a lower growth. I'll leave it at this and maybe pass on to Poonam to take over for the...
Thank you very much for setting that stage, Mridul. The global economy is actually very, very important currently, so that backdrop is very useful for us to understand where the Indian economy is currently and where it's heading. So rather than projecting growth rates ourselves, we are looking at the projections made by most others. And so what is here on the screen is the growth projections, some of the prominent growth projections for this year as well as the next year. And the two things that are interesting, first, there is a rather wide range of the estimates for this year. Goes from 5.7% to 7.7%. We have also listed the month during which these growth projections were made. So these are fairly recent as September or October. The average projection, whether you look at the median or mode, is 7%. The mean is about 6.8%. So basically, more or less, the consensus is that taking into account the way the global economy has been unfolding, India will potentially grow at 7% this year. But equally interesting is the projection for next year. Just as the global economy is slated to slow down next year, the Indian economy is also being widely expected to experience a much slower growth rate. Here, the caveat that we need to keep in mind is that forecast can be wrong in either direction. Often it's very hard to forecast 6 quarters in advance. So if I look at the end of next year, I'm really talking about projecting for next year 6 quarters in advance. And as soon as the Indian GDP quarterly data comes out at the end of this month, all of this will get revised again. So we need to take certainly 23-24 with a pinch of salt or maybe a fistful of salt. And for this year, there is, let's see what the numbers are later this month and how they will get revised in either direction. What instead we have done is we have looked at each and every high frequency indicator that exists out there. So those of us who were doing macroeconomics until 4 or 5 years ago, we didn't have the luxury of looking at the high frequency indicators. But now, in the last few years, these indicators have come out. The high frequency indicators are the variables for which we have data mostly at monthly frequency. And these are available maximum with a 1 month lag. So if we want to understand the direction of the economy, then one can look at what these high frequency indicators are telling us. So we quite diligently looked at all of these indicators with the last data point available until September or October of this year. And what we see is these indicators projecting growth and resilience. And we have listed all the variables where we see overall buoyancy in the economy. We do see some weakening. And so one of those variables is exports of goods. But I would caution that it's some weakening, not definite weakening as yet. And I'll show the chart on that, it being a very important variable this year. And another weakening is in the reversal of capital flows. When we say reversal of capital flows, it's important to point out that it's non-FDI capital flows. And this distinction is somewhat important also from the policy framework that we want to have in mind as far as the liberalization of our capital account is concerned. And more on this in a little bit. So from here, now we will look at some of the key variables of the economy, such as inflation, fiscal deficit, current account, capital account, and so on. Given that inflation is a variable which is important and relevant for almost everybody, be a consumer, producer, or the policy maker, the fact that inflation has accelerated in recent months is of significance. So what we have done is we are looking at both the average inflation this year as compared to the last 2 years, but we also dig a little bit deeper to understand the sources of this inflation. In particular, where exactly is it concentrated? And this exercise was revealing to us. So the average inflation this year from April till September has certainly accelerated to 7.2%, which is higher than the upper limit of our inflation targeting framework. But when we dig a little deeper and at one level just look at the 3 broad categories of our CPI basket, which is food, fuel, and other, clothing and housing and footwear and miscellaneous, then this acceleration actually is more or less fully concentrated in the food component. The contribution of food to inflation has accelerated from 2% during the last year to 3.5% this year. Now, it was an interesting and intriguing observation, so we dig further into food. And lo and behold, a major part of this acceleration is actually concentrated in vegetables. So out of that 1.5 percentage point acceleration, nearly a 1 percentage point acceleration is concentrated in vegetables. So it has a couple of inferences that we can draw from here. One is, if it's vegetable prices, that means it's not as yet imported inflation. Second, it's likely to be transitory. Vegetable price, they do fluctuate, but they also revert to the mean within months. And third is that when we are thinking about the food inflation or vegetable price inflation, a better demand and supply management is important to insulate the economy from such inflation accelerations. So this is our analysis on inflation. We'll be happy to take Q&A questions during the Q&A afterwards towards the end. Another part of the economy that we look at is bank credit. As we all know, bank credit has been highly subdued for months and years prior to the current year. But the cycle has started to turn around. In fact, the latest data point for September 2022 shows bank credit growing at nearly 15%, which is, I think, highly remarkable. And so one question that one may ask is the quality of this credit growth. Now, at this point, data is not available either at a sectoral level or bank ownership level who is extending this credit. But the hunch that we have is a large part of this credit growth is coming from the private sector, because that's the segment that has been growing in the last few years. And if so, one can possibly expect this quality of growth to be high quality, given that they have had better risk assessment capabilities. Another important part of the banking sector is the non-performing assets. And here the data is a little bit dated. The numbers that we have here are from the June 2022 report of the RBI, the Financial Stability Report, which predicted the NPL ratio 5.3% in a baseline scenario. And of course, they have an upside and a downside scenario as well. And more light will be thrown on this number when they publish the next report in December. So as of now, our best guess is 5.3%, which is a pretty decent number, both in an absolute sense, but also in a relative sense and compared to the past NPL ratio numbers. Now we move on to the fiscal tracker. There's a lot we read about, both in real time, but as well as in a structural sense about India's fiscal outcomes. So what we have done here today is we are looking at the central government's fiscal outcomes using monthly data for this year. and comparing it with the trajectory of the last 3 years. So that's the high frequency real time observations on the fiscal outcomes. In the next slide, we'll also look at India's combined fiscal outcomes at the center and the state level over a long period of time. So first, looking at these monthly movement of deficit, receipts and expenditures of the central government, something very interesting comes out of this exercise as well. So during the first 6 months of this fiscal year, the last data point that's available is September 2022. The central government has incurred expenditure at less than 50% of the total that it has budgeted for the year. It has collected more than 50% of the budgeted revenue receipts of the year. And an outcome of both of these is that it's only running 38% of the fiscal deficit budgeted for this year. So if the same trend continues, one can assume that the budgeted fiscal deficit of the year would be either met, and perhaps there will be better than met, in the sense that the outcome would turn out to be lower. So this is as good as the data tells us. It's anybody's guess what the last few months of the year would be. But if we look at our fiscal deficit and debt in a slightly longer term framework, and here we have combined centers and states' fiscal outcomes, a few things stand out. One, it's easier to describe the situation as that our fiscal outcomes are sticky. So tax and non-tax revenues grow very slowly as percentage of GDP. So all of the variables presented here are as percentage of GDP. And the nature of these variables is that they move and evolve very slowly. So tax revenue to GDP ratio is 16.5%, and it has remained at this level in the last decade and a half. Non-tax revenue to GDP ratio is small to begin with, about 3.5 percentage point of GDP, and has moved very, very slowly, if at all. Revenue expenditures are large, both as percentage of GDP, but certainly in comparison to capital expenditure, and they are about a quarter of our GDP, and they remain at more or less that level. Capital expenditure is very important, and it has been growing in proportion to GDP, but at a very slow pace. So the best we have done is 4.5% of GDP that is expected, that was achieved last year. So an outcome of all these variables is that general government debt to GDP ratio is high. It has been hard to bring it down below 70%. During COVID, both because of a shrinking denominator and an expanding numerator of debt, debt to GDP ratio has increased to a somewhat unprecedented level of about 84%. And at NCER, we have done these very simple projections of where it would be heading under very simple assumptions. The assumptions can be as agnostic as that nominal GDP growth will be at the same level as in the last 10 years. Primary deficit will remain at an average level of last 10 years, and so on. I will, thank you. But it's hard to find a case that under those simple scenarios, debt to GDP ratio will decline. For it to decline, nominal GDP growth has to be much higher than in the past. Those are our scenarios B3 and B4. The assumptions are that nominal GDP growth is much faster. So I think I have already summarized all this. I'll just take half a minute on the financial markets, and here we have picked up two variables. One is our equity markets, and the other is bond yields. Again, we see a huge amount of resilience in these two variables. Despite the public debt to GDP ratio being high, bond yields have been quite anchored. 7.5% is a highly benign number. And we all know, and most of us are perhaps invested in the equity markets to know, that India's equity markets have outperformed the global market indices or emerging markets. External sector is where I'll take 2 to 3 minutes because it's an important sector this year. So what we have seen right now is that global backdrop is becoming challenging. Indian economy is showing a lot of resilience, but even so, as Mridul mentioned, the global environment has implications for India. And these global developments impact India through a couple of different channels. One is, of course, export of goods and services, oil prices, which are important, current account deficit, which is the reflection of both how goods and services exports and imports are doing, and how oil prices are impacting our economy, but also capital flows, which have implications for our overall BOP, exchange rate, and reserves. So, what we have seen, again using the high frequency data, monthly data on exports and imports of goods and services until September this year, exports have grown very, very well in the past year and a half or the past 15 months. Even so, there is some softening of that momentum in the last 3 to 4 months. Exports of services have continued to do well, and as we all know, India has been gaining share in the global market for services all along for the past 10 or 15 years, and that trend has continued. But what is interesting here is also that if we look at the left-hand side chart here, the export growth rate of goods from India co-moves very, very strongly with that of the world. So India has not decoupled in that sense. I'm aware that this data is only till 2020, and it's possible that this year India will do much better than the global trade outlook, but at least in the previous years that has not been the case. There are only a handful of countries which are able to buck the global trend, and Vietnam is one of those countries, that whether the global trade outlook is weak or strong, Vietnamese exports of goods have continued at a very brisk pace, resulting in in Vietnam gaining a share in global export quite handsomely from 0.6% in 2012 to 1.6% in 2020, which is the same as India's stagnant share in the global market. Now, oil prices are important. We are an oil-dependent country. We do export, I think, nearly 70% of our consumption of oil. Oil prices did increase to about 100 earlier this year. They seem to have peaked out. They are hovering in the range of 90 to 95 currently, and hopefully they'll settle at that level. The World Bank has projected oil price to be 92 next year, and this is the level of price that the Indian economy can be resilient to. I won't have the time to explain what I mean, but happy to take questions afterwards. Something interesting that we see in the data is that in a structural sense, India's dependence on oil consumption has been declining. What do I mean by that? So if our real GDP growth has been about 7% in the last 15 or 20 years, oil consumption has been growing only at the rate of 4%. So this is the volume of oil, which means that oil intensity of India's GDP has been declining. In fact, a similar phenomenon is observed around the world and for the global average. The implication being that the importance of oil prices for the Indian economy will continue to decline, and perhaps this reduced intensity will intensify in coming years as we move more to the renewables and as we improve the energy efficiency of our economy. Now, capital flows are important, so I'll just take a minute and a half, and then I'll conclude my presentation. When we talk about capital flows, it's important to understand that there are two kinds of capital that the Indian economy attracts. One is FDI, one is everything else. Everything else includes portfolio flows, NRI deposit, and external commercial borrowings. FDI worldwide is a stable form of capital. All other forms of capital are volatile. And it's also, in a way, pro-cyclical. It's not necessarily driven by the needs of the economy, it's driven by the external factors, which is interesting and important from the policymaker's point of view, that you can have situations when you don't have absorptive capacity in the economy, but this capital just continues to flow in. Dr. Mohan isn't here, but he would relate to that phenomenon. And then there's situations when you want this capital to stay back in the economy, but it chooses to reverse. And this is the situation we are going through currently. So India's economic situation is quite robust and resilient. And at the same time, we have portfolio capital which is reversing due to global factors, not because we don't welcome that capital here. So I think just this chart may actually be indicative of what I'm talking about. On the left hand side, we can't see the colors too well, but there's supposed to be a black line, which is net FDI flows, which have been increasing and which are stable. They are ups and downs in a very small range. And then we have net portfolio inflows. They become negative, they become very large the following year, and so on. And there is a huge literature and experience on the kind of challenges they give to the economy. And one does not want to be a central banker under the current situation where it's happening. Another comparison which is striking with Vietnam is the large amount of FDI they receive as a percentage of GDP compared to India. So just an example of how this capital portfolio capital flows have been retrenching from India. If we look at the monthly data from October 21, we have, during most of the months, there has been a negative inflow of this capital. And at its peak, nearly 35 billion of the capital had retreated from the economy. So overall, the projection, it's not our projections, but we consulted a lot of people who do projections. Overall, the estimates are the current account deficit would be about 3% of GDP, which is much more than 1% that we had settled at in the last few years. Given that capital inflows are going to be smaller in the past, there's likely to be an overall BOP gap of about $40 to $50 billion this year, which is of significance. India is not alone in this capital being reversing from the economy. In fact, the entire asset class of emerging market economies are experiencing these reversals of capital flows. And when this capital reverses, the implications for exchange rate depreciation, equity market, and bond yields. And here we have just ordered it by the quantitative impact that economies are facing. And as we can see, that the impact on India due to both the kind of resilience there is in the economy, but also the specific policy actions, the impact has been much more modulated on India than on many other countries. So I will stop here with the summary. The Indian economy, as far as the high frequency indicators are concerned, is showing growth and resilience during the year. This is despite an unusual global environment. It does not mean that the global environment is not impacting India. It has impacted India through oil prices, through slow exports growth of goods, which we are seeing in the last few months, and also the reversal of capital flows. And it's another matter that we can discuss as a part of the policy discussion, that some of these shocks we should be able to handle much better and enhance the resilience. And some of these resilience, at least on the capital account side, can be a part of the G20 agenda as well as the reforms of the international financial institutions. And NCR is working on this issue, and we would be happy to bring this work in public domain in a few weeks. Thank you very much.
Thank you, Poonam, for that excellent, extensive, detailed roadmap of India's economy, how it is being impacted by the global developments. We'll now have comments from Mr. Amitabh Kant.
Let me first compliment Mr. Mridul, Saggar, and Poonam for two outstanding presentations on the state of the global and the midterm economy and the midterm review of the Indian economy. So globally, the risk of recession in the developed countries, they weigh heavily on the growth prospects. The spike in commodity prices after the Ukraine war It has actually prompted central banks across the world. They are all acting in a coordinated manner to stem rising prices. Now, the rising rate of cycle really implies a higher cost of borrowing for the rest of the economy. And very aggressive tightening by central banks, with successive 75 bips hike by the Fed or the recent 75 bip hike by the Bank of England. And that is their biggest, England, that has been the biggest in the last 33 years. Actually, all this has led to taking interest rates to actually decadal highs as well in most developed countries. And these aggressive rate hikes, though necessary to contain inflation, will present a trade-off to growth in the short run. And over the year, we've seen revisions not just to India's projected growth for 22-23, but also the world. I think the important point to understand is that being a net importer of energy, we face the twin issues of a rising import bill and depreciating currency during commodity price shocks. And combined with reversal of some capital back to developed countries as the dollar strengthens, India's currency and foreign exchange reserves will come under substantial pressure. For this year, 22-23, as Poonam pointed out, we are expected to grow at about 7%. And some studies are predicting a slowdown next year. However, despite, important thing to understand is that despite the global turmoil, the Indian economy has emerged as a beacon of hope. All our high-frequency indicators have been actually encouraging. Tax buoyancy is actually improving as reflected by improving GST and direct tax collections. GST revenues actually have crossed 1.5 lakh crore mark in October 22. That's the second highest ever collection ever recorded. And the data released in October 22 showed that direct tax collections also for the first half of 22-23 were 23% higher than last year. Now, these figures do point to the resilience of the economy to the global shocks of 2022, to my mind. Manufacturing PMI remains in the expansionary zone, indicating the robust nature of India's manufacturing recovery. The reading for October came in at about 55.3 as compared to the long-run average of 53.7. And interestingly, according to PMI results, capacity pressures are being witnessed by Indian manufacturing due to increased demand. They have resulted in the fastest pace of employment since March 2005. Poonam spoke about the credit rate growing at about 15%. It's largely by the private sector, but I still believe that while Indian public debt may be high, India's private debt is still very low. And we need to expand credit to the private sector if you want to grow at high rates. And that's very, very important. Overall, India's manufacturing remains buoyant. And I expect expansion in volumes next year as well. I'm a great believer that if India is to grow at high rates, India needs to fire on all cylinders, not just the services sector, and manufacturing is important. Even agriculture growth is important. And we've had some recent successes in some new areas of growth. Mobile manufacturing. Earlier, Apple manufactured only legacy phones in India. Now, iPhone 14 is not only being made in India in addition to China, but we are releasing it almost at the same time. There are some estimates by our mobile industry that almost a quarter of all iPhones will be made in India by 2025. And this is important to understand that India's manufacturing can only grow if it gets into some of these sunrise areas of growth. And actually, the PLI scheme are now starting to pay off. Advanced chemistry cell, batteries, semiconductors, solar PV, telecom, pharma. These are sectors which we have targeted in the PLI schemes, and these will go on to build our manufacturing capability. The other key important point is that our investments in physical infrastructure, there's a national infrastructure pipeline that is about 100 lakh crore, and an innovative program such as asset monetization, 6 lakh crore, they are critical. If you want India to grow despite the global shocks, you need to put resources into infrastructure, you need to push more private-public partnership. And there a lot of homework needs to be done by the government. Secondly, I am a great believer that the government needs to, this is the time the government needs to accelerate the pace of disinvestment. If we do not accelerate the pace of disinvestment, our growth will slow down, because you need private sector to come in, and then you need credit to flow in, and that whole virtual cycle of private sector, credit flow, etc. is important. And I think the government must be very, very aggressive about asset monetization. If you want to raise productivity in the economy, there are vast assets which the government holds, which are performing to very low levels of productivity. Government needs to push them out into the private sector. For instance, warehousing. I mean, you have Central Warehousing Corporation, you have Food Corporation of India. All these need to be put out, and they should catch the eye of global investors. I also think that the master plan in the form of the PM Gati Shakti is very, very critical. It's really important, because this is leveraging cutting edge technology, and this is breaking down silos. So if you're making a new city, you bring in road, you bring in train, you bring in metro, everything all together, and this will help us to build world-class multimodal transport system. We are also getting into very futuristic areas of growth. I think the most competitive areas will be digital and green, and which is very, very important. Poonam spoke about our dependency on oil coming down because of renewables, but I really think that it's important to understand that electricity is only 20% of energy. Only 20%, 19 to 20% of our energy, and it's very important to focus on hard to abate sectors like refinery, fertilizer, steel, cement, and with the Europe border tax coming up in 2026, it will be impossible to export without going green. And it's important that we use the strength of our renewable and our climatic conditions to crack water, use electrolyzer to produce green hydrogen, and India has the possibility of becoming the lowest cost producer. Like what the quantum jump we've done in digital technology, we must do the quantum jump in green hydrogen, become the lowest cost producer of green hydrogen, and become the production hub and the export hub for the rest of the world in green hydrogen. This is, to my mind, will play a very pivotal role in reducing emissions from hard to abate sectors, and this is very important. And India actually should take the challenge of becoming the first country in the world to industrialize without carbonizing. If you do not go digital, you do not go green, you will not be able to attract value, and you will not be able to attract capital from other parts of the world. We've done we played an extraordinary role in creating digital public infrastructure. We've demonstrated that our digital payments are 7x of what US and Europe do. We do 3x of what China does. We do 20% more than what China and China and USA do. All this is this has enabled us to leapfrog, and this will drive growth for many years to come. So the digitization and formalization efforts that have taken in the past years will pay us huge results, along with economic reforms. GST, IBC, RERA, direct taxes, they will all bear huge results in the coming year. And it's important to say that because of this digitization, data will be central to our future growth aspirations. We'll go from a data-rich country to a data-intelligent country, and all this AI, ML, 3D printing, genomics, the liberalization carried out in geospatial mapping, drones, all this will enable us to drive the next industrial revolution. One or two other points I want to make, and that is that it's important that urbanization will have to play a very key role. Cities will have to deliver, because if you look at the other point I want to make is that states, whatever you do, it's important to understand that while some states like Goa, Sikkim are growing at 5x of India's growth rates, Some states like Maharashtra, Gujarat are growing at 2x of what India grows, but some states like UP, Bihar, Jharkhand, Rajasthan are very critical to India's growth story. And therefore, they have to really now bring in the next revolution in terms of infrastructure, in terms of enhancing manufacturing. And it's important to understand that the more resources you put into agriculture, the more resources you put into rural development, etc., will not enable you to grow, because it's important to understand that Gautam Budh Nagar, one city of UP, gives you 10x the GDP of the next city, which is Kanpur. And therefore, urbanization will be very, very critical. The other point I want to make is that there is a huge decoupling between US and China taking place. While Apple has invested here, it's very important that in this decoupling we work with leading companies of the US. I mean, there are a whole range of companies like Dell, Cisco, there is Hewlett Packard, there's Microsoft, many companies which we need to handhold and give them a red carpet. If we lose this opportunity now, we lose the opportunity for the next decade. And because of that decoupling, we must ensure that these companies relocate, and whatever it takes, that will give you the size and scale of manufacturing and help you build component manufacturing for the next decade or so. So I'm a great believer that this reforms must continue unabated for the every day, every minute, every month we have to think of a reform process. We must dismantle all the rules, regulation processes if you want to grow. Global shocks are the best opportunity to carry out radical reforms. If you do not push for radical reforms now, you'll lose this opportunity of growth. We must become the easiest place to do business in. We must use the opportunity of decoupling of US and China. We must push for greater private sector debt. And we must ensure that states which have lagged behind in India must become the driver of India growth. If UP, Bihar, Jharkhand, Chhattisgarh, Madhya Pradesh, Rajasthan start growing at 10%, that means India's story will be the story of growth for the next decade or so. These are critical points that I wanted to make. Thank you.
Thank you very much. I think the room looks a little depressing, but it has lit up. So thank you for those fantastic comments. Mr. Kant has to leave pretty shortly. So if somebody has a pressing question or two, maybe we can, to him, we can take it now. So let me just see. How many hands are going up? 1, 2, 3. Oh, good. Okay. So what we'll do is all 3 questions first, and then Mr. Kant can answer them all 3 at once. Okay. So.
Okay. Thank you to all the speakers for wonderful presentations, and Mr. Kant's was really wonderful. I had a question. You mentioned that urbanization should be increased. How would that affect the agricultural sector? There will be a huge migration to the cities.
Let's take the remaining 2 questions
Yeah,
also.
sure. I'm just noting.
Okay, so this one here, yeah.
Thank you, Dr. Panagariya. Since Dr. Amitabh Kant has to leave, he's one of our dynamic thinkers whom I respect very much. But I'm surprised why he did not talk much about the supply chain management issues, which are very crucial if one wishes to have both production up and exports up. And there are opportunities now that MNCs are selectively leaving China. And furthermore, we have to understand what is special about Vietnam, Bangladesh, and countries like that, where they are capturing a lot more, which we could have also done if we had taken effective steps. I stop here. There are other questions later. But Dr. Kant's response will be highly valuable. Charan Vadva is my name. I did.
Good morning, Mr. Kant. I'm Amit Khanna, Head of Marketing from Safe Express. So you spoke about Gati Shakti, PM Gati Shakti project, multimodal transport system. How do you see the future of supply chain logistics in India by 2025?
John Reed from the Financial Times. Thank you for the excellent presentation, Dr. Kant. I was curious about how you think, what specific steps India might need to take to capitalize on the decoupling of India and China. I'd be curious to hear. Thank you.
Couple of very interesting questions, and first and foremost, on the agriculture point, I want to just say that India's, our dependency on agriculture is just too high in terms of if you're getting about 19 to 20% of your GDP from agriculture when the worldwide average is 4%. If 42% of your total workforce is dependent on agriculture, you'll have very poor quality jobs, and that is why you see this huge migration taking place from Bihar and UP and all this. So first thing, I think all of us in this room at least must be very clear that you have over dependency of your workforce on agriculture if you want to grow at high rates. And it's very important to understand this, because one city of India, Mumbai, gives you more GDP than the entire GDP of Uttar Pradesh. And that is that if UP was a country, you must understand, if UP was a country, it will be the 5th biggest country in terms of the population in the world. And therefore, you're giving very poor quality jobs. And if you want to grow, you need to urbanize and grow, do your urbanization on the back of manufacturing, create new cities. What is happening in India is that unplanned, unsustainable urbanization, instead of taking place, we should do planned, sustainable urbanization, and that should be linked to, good transportation, and that will really drive your growth, because that is what manufacturing requires. So I am a great believer, unlike you, that agriculture is, the more we've been doing agriculture, we've been doing anti-poverty, we've been doing rural development for 70 years, we need to completely refocus to other areas. Second is, Mr. Charan Vadva's question, I spoke about the decoupling of the US, China, and I also mentioned several companies, which is important as global supply chains are disrupted. There's a huge decoupling taking place. This is an opportunity for India. We came out with the production-linked incentive scheme, which is, some economists have talked about it being protectionist in nature. Let me first of all tell you that it's not protectionist at all. It's aims at your size and scale of your manufacturing year after year, year after year, year after year for 5 years in a row. That the targets are very, very high. That means it's not export oriented, it's production oriented. My belief is that you can become a great exporter only if you learn the art of producing to size and scale. So what it says is that if your base level is here, you have to go up to here next year. And from here, you have to again jump 20% next year, and then jump 25% next year. So every year for 5 years, you have to keep growing bigger, 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 and become the biggest. If you can't do that, you will not get your benefit. So production-linked incentive is about getting size and scale right in this. So it's not protectionist. Protectionism is what America has done through this Inflation Reduction Act of saying that we'll give $3 of subsidy for hydrogen, green hydrogen, if you produce only in the United States of America. Even if the climatic conditions are not good, even if India produces at almost 20% the cost of US will produce, we will subsidize only production in USA. That is protectionism. This is not protectionism. And I think Gati Shakti program is very critical. It's, to my mind, it'll radically improve India's supply chain logistics, and this will make a huge jump. Not only this, there's a huge process of digitization which has taken place across almost 50 different portals of private sector and government. That digitization across through the Unified Logistic Interface Program, that is path breaking. So Gati Shakti along with ULEP will make India do a quantum jump in infrastructure and radically bring down the cost of infrastructure in India. That will be that is, to my mind, critical. Thank you.
Thank you very much, Mr. Kant. Anant?
Thank you, Dr. Panagariya, and thanks to NCAER for inviting me to share my thoughts on the mid-year economic review that they have put out. And it is apt that the slide that is out there in front of us is the right starting point. But since I have spent about 20 years in the financial market space, let me start with one piece of statistic that many of you may not be focusing on, and that kind of sets the stage for my observations. India, as you know, according to Moody's, has a BBB minus credit rating, and India's 10-year bond yield, the cost of borrowing for the government for 10 years, according to the market, it is 7.47%. Indonesia has a BBB credit rating, that is one notch better than India, and it is able to borrow for 10 years, the sovereign I mean, at 7.48%, just about 1 basis point higher than the cost of borrowing for Indian government for 10 years. The Philippines has a rating of BBB plus, which is 2 notches above India's, according to Moody's, and it can borrow for 10 years, the sovereign, at 7.55%, which is about 9 basis points or 8 basis points higher than India's 10-year borrowing cost. Now, last few months, Indian 10-year bond yield came down, and people said that was because of speculation that the Indian government bonds would enter some global indices. But now that speculation has died down, but yet Indian bond yield hasn't really spiked up, and if anything, is doing better than those which have a slightly better credit rating than India. So that kind of tells us a little bit about the overall macroeconomic stability that is there under the current circumstances. We saw in one of the earlier slides the projections for growth rates for next year, which ranges from 5.2 to 6.5. If you look at RBI itself as 6.5, consensus sort of converges around 6. I'm talking about 23, 24. And 22, 23, of course, the range is between 6.5 and 7. Now, the kind of situation that we face, it is not just about the question of dealing with known unknowns, but also naturally lots of unknown unknowns. And therefore, projections can be very wide, and we all need to take them with some skepticism, both very optimistic ones and very pessimistic ones. So if you look at UNCTAD, for example, it's always been the case that UNCTAD's model somehow produces a number that seems to be well below consensus for India, and we need to take a look at why that is the case, whether it is a model problem or something else. But let's keep that aside for the moment. If you look at the unknown unknowns, what is happening is in the central banking space, it's very interesting that although the Bank of England raised interest rates by 75 basis points this week, and we had Bank of Canada, Australia, ECB, all of them raising interest rates, but also putting out commentary that they do not see themselves continuing on this path, at this pace for quite some time. Excepting the Federal Reserve, which actually went out of its way to clarify to the market that they are not done and that any talk is premature. And they do see the peak rate higher than what the market is currently expecting. Others actually kind of said that they would be looking at taming their pace of rate increases, and maybe the peak rate will be lower than what the market is suggesting. If that is the case, then what we are seeing is that central banks in the developed world may end up with real negative interest rates for the foreseeable future, maybe lasting into the end of the decade, because they do have a huge debt stock to deal with, which was created after the 2008 financial crisis, further aggravated by their response to the 2020 pandemic as well. So the one country that stands out at the moment is the Federal Reserve, and that's what matters to all of us, given the dollar's role in the global markets. But the question is, as we had an accident in the UK pension fund industry last month, will there be an accident in the shadow banking world in the United States? After all, by definition, shadow banking is outside the framework of regulations. So if that And if you look at the behavior of financial markets, that actually accentuates the risk of some shadow banking accident in 2023. Because the financial markets, no matter what Mr. Powell is trying to do over the last 6 to 8 months, has actually been more habituated to the kind of signals that they have been getting in the last 20 years from the central bank, that they have their back, that the central bank has its back. And that is the message that they have internalized so well that they are finding it difficult to let go of it. No matter how many times Mr. Powell repeats that he doesn't have their back now. And there is no Powell put, at least on this occasion. So the more they rally and the more they are in denial, the greater is the risk of an accident next year. And that might be the one that stops the Federal Reserve on its tracks. If that is indeed the case, far from the problem of having to deal with currency depreciation, which we are facing this year, the problem that may actually confront us in 2023 and beyond might actually be a case of managing currency appreciation. And that is something that India actually has to think about starting from 23 or even 2024. Well, let me move on to other comments. So that is why I mentioned about the currency being a two-way risk for India, more on the appreciation side. That brings me to the question of external stability. Yes, we heard a lot about the oil deficit, non-oil deficit, and the overall trade deficit. Including services, you can talk of India's trade deficit being in the region of between 4 to 5% of GDP. Including services. That's on the high side, because then no matter how much of remittances we have, and we had a pretty good remittance flows from Indian expatriates into India in 2022 calendar year, 2021, and that might continue this year as well. So the current account deficit at the moment is about 3 to 3.5%, depending on what your expectation is for the denominator GDP for the current financial year. In this situation, what is really important for us to worry about is the oil price cap that may come into play on the 5th of December. And basically, which means insurance and shipping services will not be available to those who buy Russian crude at a price above the cap that is yet to be revealed to us. In the meantime, what has happened is, given the way the cap has been structured or being talked about, that certain contracts entered into before December 5th will not be subject to the oil price cap. So what you are seeing, and you can see in the media reports, just as tankers are loaded with liquid natural gas and waiting to be actually sold at a higher price, similarly, oil traders also are stocking up on oil, because oil bought before this date will not be subject to the cap and can be sold at a higher price. So the way the cap is being discussed is actually going to create unintended consequences. Even without this strange way of exempting and creating cutoff dates, the oil price cap in itself could have created a lot of unintended consequences, but even more so, given the way these cutoff dates are being talked about, is creating even more distortions, and that is the big worry. But as everybody has discussed, it is a bigger problem for Europe, it is a bigger problem for many other countries, but it will be a problem for us also. Therefore, we should be prepared on balance for the balance of payment to be in deficit this year and next year. But if that is indeed the case, it is not the end of the world, because we do have, including gold, about $530 billion, and current account currencies alone about $480 billion worth of reserves as of end of October, and we should be able to ride through this phase, because FDI flows are stable. And if you look at the portfolio flows, what is interesting is, since July, portfolio flows have by and large turned positive, and even the two small negative months we had in September and October, they were less than $1 billion each in terms of net outflow. So July, August, September, October, and in the first few days of November, already the inflows are $1.6 billion on a net basis. So it is quite possible that the FPI flows, and you are hearing commentary from many investors, hedge fund managers, and Gavekal Research, etc., that no longer do they consider China as an investable market, given the kind of political turn that has taken there. So in that sense, overall, taken all things considered, including the risk of the oil price, I do believe that the external situation will be manageable, with, of course, some anxious moments to come. So what really, and I will end my remarks here with one last point about, given all the short-term unknowns, it is better to focus on the medium term, what lies ahead for us in the next 6 years until 2030. The medium-term growth outlook, I would dare say, is actually constructive, very simply because we have paid our growth dues last decade. And that was because we had to undergo balance sheet repair in the financial and non-financial sectors, again, because of the excesses we engaged in the first decade of the new millennium. So second decade turned out to be a decade of balance sheet repair, and we are encountering the global shocks, fortunately, with far better household, corporate, financial sector balance sheets. If we have the balance sheet today that we had in 2012, I would be extremely worried. But that is not the case, and that is an important source of strength and stability to us. And therefore, I would posit that the medium-term growth outlook, roughly around 6% according to many international organizations, is probably likely to be on the lower side, subject to a lot of assumptions about how the global economy behaves, oil price behaves, etc. But keeping that aside, taking a baseline scenario of oil under $100, etc., our medium-term outlook could be closer to 6.5 to 7 rather than closer to 6, because capital formation cycle will turn up, and there are already incipient signs that it is happening. And the second reason for my relative optimism is the public digital infrastructure has come of age. And that is leading to formalization and is also facilitating access to finance. And we are engaged in a study that would try to quantify its impact on the overall potential growth. So with all those caveats, I feel we should be able to grow on an average between 6.5 and 7, subject to some global conditions being relatively benign, if not overly supportive, at least neutral. However, what we need to remember in terms of discourse is to put our head down and continue to work, and rather than celebrate prematurely about India having arrived, because we have done that in the past, and on few occasions they have turned out to be premature. China rose its head only after 2008 crisis, thinking that the momentum of global growth has shifted away from the west towards the east, and now they are finding that that indeed is not the case, and within 12 years their own growth outlook looks rather questionable. So I would basically be very comfortable if we don't have the kind of reports that I have seen in the last 2-3 days coming from many investment banks talking about India's decade and India's century, etc., because we have a lot of work to do. And while we should be very happy with the fact that relatively speaking we are doing much better, and because of many of the reforms we have done in the last 8 years or so, and the balance sheet repair that we have undertaken, we also know that we have a lot to do in agriculture, in electricity, and also in the overall primary and secondary education, and the skill portfolio of Indian youth compared to what the jobs would demand going forward, whether it is artificial intelligence or green transition, etc. The kind of skill set that would be needed will be very different from what we are used to generating. So keeping all these things in mind, we just need to put our head down and continue to plug away. The numbers and the evidence will always tell their story eventually, and we don't have to shout before that. Thank you.
Thank you, Anant. Okay, so I will make a few remarks. And my first remark really is that I must say that I find even the optimists in India to be too pessimistic. The numbers I have seen on growth rate, let's say I'll begin. So I'll make 3 broad points. One about what I think of the growth rate in the immediate short run, which is this particular fiscal year, 22-23, how I see medium to long run. And so take that to mean maybe the next decade. And one last set of points I'll talk about has to do with the global economy. How serious a constraint is it likely to be? So first of all, Poonam had that chart of forecasts, and my forecast really for the current year 22-23 actually is to the left of the Moody's. As you may recall, the Moody's was 7.7%. I think we'll certainly hit 8%. And let me explain why I think it's a very simple arithmetic point. For the first quarter of this year, 22-23, we already have the figure. That's 13.5%. Now, for the growth rate for the entire year to hit 8%, we need the, roughly speaking, these quarterly growth rates for the 4 quarters to add up to 32%, and 4 quarters, so divide by 4, 8%. It's not exactly that, but roughly, I think that's a reasonable way to do the calculation. So we got 13.5%. That really leaves me to put up another 18.5%. Can I do that in the next 3 quarters? Meaning, growth rates added up across these 3 quarters, can I get 18.5%? Now, Q2, the second quarter, I have fantastic actually base effect. The GDP in 2021-22 in the second quarter was still only 1.9% above the 2019-20, the last pre-COVID year. So the 2 years have passed and there's still only 1.9% above the corresponding quarter in 2019-20. I think is a huge scope clearly for the catch-up. And I've heard really nothing about this quarter in the current fiscal year, which makes me pessimistic, right? If I'd been hearing all the high-frequency indicators that Poonam talked about, Mr. Kant referred to, the tax collection, whatever else, tells me that actually the economy has remained steady on the path of recovery. So I think, with 1.9%, the previous year's second quarter GDP only 1.9% about 19-20. It's a safe bet that we'll get actually when the figures come out and at the end of this month, about 8%. That really leaves something like, 10.5% for the remaining 2 quarters. That's like 5% each, or 5.5 and 5. It's completely doable. So my basic arithmetic is that it's completely doable. Another way to look at it is that there are certain sectors which are still very depressed. We have been, they've not recovered actually even fully from where 2019-20 was. And these are the mostly contact-intensive sectors. So if you look at trade, transport, hotel, communications, broadcasting, that was last year in 21-22, it was still 11.3% below the level in 19-20. So we have not even come to the level of 19-20. So that gives you a great deal of scope. Mining and quarrying, electricity, water, gas, construction, which is a very large sector, of course. These sectors are only 3.5% above the 19-20 levels in 21-22. So once again, fairly substantial scope, and all the indicators that we are actually observing are in the very much very optimistic territory. So that's my first point, that I'm out on my limb on this, but I think that is where we are going to come out. We'll see. Medium and to long term. I think there has been in the last 4 or 5 years massive restructuring of the Indian economy at a scale that I don't think we have really seen before. There is a precedent, perhaps in around 2002-03, that a lot of the restructuring happened at that time, but the scale this time has been significantly larger. One simple example, in the last few years, Tata alone has shed something like $10 billion worth of legacy assets. That's Tata Group. But a lot of the weak companies, a lot of the unviable companies have been shut down. That has gone through the IBC process and given an exit. But then a lot of the badly managed but viable companies have passed on into more able hands. Examples are SR Steel, Bhushan Steel, but there are many more. So that is the second kind of type of stuff that has happened in terms of restructuring. And here, what I am really very much influenced by is the restructuring of the Korean economy post 1998 crisis. Around that time in the 1990s, it had begun to look like Korea will also be the victim of this middle income trap. And there were several years during which the growth rate, and they were really something like 10,000, 11,000 per capita income there, and had not been growing at a significant rate. And so they feared that they would also fall into this middle income trap. And then this crisis came, and huge amount of restructuring happened in the Korean economy. And then, of course, it grew at a very, very rapid pace once again, and it got out of that middle income trap. I think something like this is happening. We are still not in that kind of league. We are still 2,300, 400 per capita income in dollar terms, but certainly the restructuring is of that nature. Banks' balance sheets are much healthier, and we are beginning to see already the credit growth in the private banks. But I think we'll see the same very soon in the public sector banks also, because that is where the bigger problem actually existed, which has now been solved. I mean, private sector banks already didn't have that kind of problem. So there I would perhaps attribute to the growth, to the demand side returning. That the momentum in the private sector lending perhaps has been driven by the demand becoming robust, but the supply side reforms that happen, and particularly the fixing up of the balance sheets of the public sector banks, which had massive problem, that effect still has not even begun to appear on the scale that it is waiting to appear. So that is going to happen as well. So again, contributing to the medium to long-term growth rate. Even the non-bank finance company sector and BFC sector actually went through a crisis in beginning in 2018, and the big company there, Ireland FS, has been fixed up. So even in BFC sector now will very likely be doing a lot better. So that's one set of points, that the massive restructuring has already happened, and the growth cycle of the kind that we experienced beginning in the year 2003-04 will probably be coming back in the next decade. Now, this is also propelled by the economic reforms. I won't count them all. The very large number of reforms have in fact been introduced in the last several years. We can come back if we want to discuss it, but I think that has happened, and that is going to be driving as well. And in particular, the two things I should mention in addition to the reforms, also the infrastructure build-up. It really has picked up the kind of speed that we have not seen before. You look at the rate at which we're constructing roads, the bridges being built up, railways, electrification, whatnot. That's one part of the infrastructure. The digital infrastructure is the other one. Again, globally, I think the lowest digital, lowest cost digital infrastructure, and I mean, kinds of things you can do here. US is, I find, very far behind. You're just making a transfer of funds from bank A to bank B, even when I hold both the accounts, is a challenge in the US, particularly if the amount involved is large. Small amounts happen fast, but sitting in the US, actually, I am able to operate much more efficiently my account in India. I mean, very, the transfer is in real times, and it doesn't matter what the amount involved is. That's just one example, but Mr. Kant actually gave you tons of numbers on that front. So the global last set of points have to do with the how I see the global economy impacting us. Now there's a lot of pessimism that comes from there. But I look at a couple of broad things. One simple fact is that in what way does a country like India get impacted by the global developments? One of the biggest one is that what happens on the export markets, and there what I see is that in spite of all the malaise that you see, that this US-China trade war going on, automation happening and protectionism happening, this, that, and the other, the fact of the matter is that global trade is continuing to grow at a very rapid pace, and we went through this massive kind of COVID crisis, and the decline in the international trade globally was a blip, nothing. I mean, and by the year 2021, which was still a COVID year, the global exports were already back to $22 trillion compared to the previous peak, which was 2018, which was only $19 trillion. So you grew, from the pre-COVID peak of 19 trillion to 22 trillion. So it is a large economy. I mean, $22 trillion of global market is a very large market. The issue is what are we going to do to capture a little bit larger pie out of it. We are still in merchandise exports. This is merchandise exports figures, and there is another $6 trillion of services trade market as well. So in merchandise trade, our slice is just 1.7%. Compare that to China's 12%. We'll probably never get to 12%, but even if we get decent, something like 4-5%, there's plenty of scope. I mean, so the market is most certainly there. China plus one actually is fantastically works in India's favor. Finally, we are doing things to take advantage of it. You also begin to see some action happening in the market in terms of the iPhone coming in, Foxconn bringing in some larger investments being made and all. So I think this, and also if you look at what the potentials are, ultimately look, Vietnam, Bangladesh, these are still very small countries. If ultimately China is going to vacate many of these markets, things like clothing industry, most of the labor-intensive products, with the Chinese wages, it's not going to last ultimately for a very long time in the marketplace. Somebody big will have to come in to step in those shoes. And on that count, both Vietnam and Bangladesh are still smaller countries, don't have enough labor, so they will also, even if they're ahead of India right now in capturing the space that China is quitting, I think it's still ultimately India which will have the kind of scale in terms of labor force that matches that of China. So the China plus one, I think, is going to work in India's favor. Immediately, you see the signs of good things happening. One of the big things is India. Remains very strange. How the media portrays, pictures these things. You say investment is doing well. Oh no, but that's the public investment. But the private investment is not doing well. So private investment actually has gone up from something like 30% of the GDP to 33%, 33.5% actually in the quarter before, and in the latest quarter, the investment to GDP, so this is the total investment to GDP ratio, which has gone to 34.7%. We have not seen that in a long time. I don't say that this is the highest ever, but we have not seen 13.7% of the investment to GDP ratio in a long time, and it's not public investment. You saw Poonam's graphs, the latest, which is the highest, was 4.6%. The capital expenditure of the government of India, or was it the total? Perhaps actually it was the total. It was 4.6%. So the 34.7% versus the 4.6%. Most of it is private. So, don't be under the impression that somehow private investment is not doing well. Without private investment doing well, private investment doing well, you can't get 34.7% of investment to GDP ratio. Employment figures, again, now we are generating actually on a regular basis, at least urban unemployment figures very reliably. Once again, a lot of, waters get muddied in these media noises, and everybody does their own surveys and puts out their numbers. Their unemployment has gone up and all. I trust only one survey in India on employment and unemployment, and that is the Periodic Labor Force Survey produced by MOSPI. It's a damn good and consistent survey, comparable over different quarters or years, etc. That survey actually has shown, based on the current weekly status, for the last 4 quarters consecutively, the unemployment rate coming down, and the latest figure for the first quarter of the current fiscal year is 7.6%. For current weekly status, that is an extremely low figure. Actually, I've not seen this figure before since this survey started in 2017-18. Other information that you can glean on employment reinforces that. There is the EPFO, the Employee Provident Fund Organization. In the year 21-22, the net additions to the rolls of EPFO were 12.2 million. That compares for the previous 3 years, 8 million or less than 8 million. In every one of those previous 3 years, you added on net less than 8 million. So 20.2 million compared to that, 12.2 million compared to that in 21-22. So again, these are pretty robust figures. I see it actually that we are going to. So I would put my kind of once again stick my neck out and say that and where I began, that the optimists in India are still remaining a little too pessimistic. We will grow in the next decade 7 to 8%. That I say against the fact that during the first 5 years of the Modi administration, India grew 7.4%. That's again another little known and little informed figure, but that is actually the fact. Go back, check the GDP numbers. 2014-15 to 18-19 growth rate on average was 7.4%. If we could do it then, with all the baggage that we carried during that year, those years actually, now that baggage is off our backs, I just don't see how we will not be able to do 7 to 8%. So that's my pitch. Thank you. Take questions and comments if anybody would like to ask, make comments. Yes.
Professor Panagariya, excellent inputs from you on your optimism. Just relating it to the presentations that we started the morning with, everything on the presentations showed that, the growth in terms of our economy on all the parameters that were presented has been more or less, it's business as usual. And the two markets that we really got compared to, the first decade, everything was India versus China. And the China model is where they brought in a huge number of people into the workforce, and they really touched, and that's because of the way the political situation is in that country. Over the last few years now, it's always comparisons to Vietnam. And the Vietnam model is, as you said, from 0.6% of global trade, they've already gone up to 1.6%, which is comparable to India. So what they've been able to do to really grow their economy is to target the high growth, big supply chain entities and get them into their market and prioritize that. Either of those two strategies to come into India doesn't seem to be the case, because as Dr. Kant mentioned, if you really look at the Indian scenario, 78 to 79% of our top 8 cities are illegal occupants: Delhi, Bombay, Bangalore, Chennai. So how do you show this optimism where on the ground, I mean, there are projections that we've been making, and it's good to be optimistic. How do you relate it to either a transformation happening into states like UP, Chhattisgarh, or whatever Dr. Kant spoke about, or drawing in the top industrial supply chain entities like the big manufacturers to try and get the Vietnam example? We don't see either of those happening. So what is on ground making you very optimistic, besides the fact that we started with a low base in 2021 that you started off with?
Yeah. Now, remember that China, which is what you're referring to, actually grew 10% a year for 30 years. I'm not talking 10%, for the reasons that you mentioned, that kind of transformation that needs to happen of the workforce moving out of agriculture into industry and services, out of rural to urban areas, etc. That is much slower in India for reasons we can talk about. I mean, I've looked at this. Therefore, I'm saying only 7 to 8%. I'm not saying 10%. If what you are saying would happen, I will say 10%. Don't forget, again, little known fact, 17 years, 2003-4 to 2019-20, average growth rate 7.4%. How did we do that? If you're telling me all the problems that, if I take seriously all the problems you're pointing out, you explain to me how did we get to 7.4%? We did. For 17 years. That's the highest growth rate that a democracy has experienced. That's my answer.
Hello everyone, I am an economics major student from Jamia Millia Islamia, and I have a question. As Dr. Khan G20 Sherpa has mentioned that states like UP, Bihar and Chhattisgarh must also contribute to the growth story of India. But one major concern is that what we actually see is the skewed distribution of investment across the states like Gujarat is witnessing, and we do not see much investments in the states like Bihar and UP. So how do you think this skewed distribution of investment is going to affect the India's growth story, despite the fact that Bihar is such state that is growing at around 10%, which is higher than the national average for more than a decade or so, and their share of exports of manufacturing and services hasn't grown much. So what are your comments on that?
No, obviously, there are many areas where the growth has to catch up, and the catch up is happening if you look at the infrastructure that is getting created in UP, and also if you look at the GST contribution that Uttar Pradesh is making is much better than what we would have anticipated earlier, given their low overall GDP and per capita GDP as well. So I think at the margin, we should, as Dr. Panagariya pointed out in response to the earlier question, we need to distinguish between the stock and the flow of challenges. The stock of challenges will always be there for a country of this size, undergoing a transition from poor to low income to middle income, upper middle income, etc. But what is important for us to focus on is what is happening at the margin.
I can also contribute to that interstate growth issue that is coming up. So some work that we have been doing at NCER is exactly on this issue of growth, acceleration and convergence at the state level. And there are 2 or 3 facts that come out. We'll be completing this study and putting it out in public domain very soon. So we are looking at 2.5 decades worth of data. Until 2019-20, we had to skip the COVID years, they being highly unusual. So, when Professor Arvind Panagariya said that our growth has averaged close to 7.5%. So, in an independent study, independent of that statement, we wanted to look at how has growth done at the state level. So, 2 facts come out. One, growth broadly has accelerated across all states. So when we are talking about some states being left behind, we are talking about some of them, I mean, not everybody is growing at the same average rate. There is dispersion around that average. Then, of course, some states are growing slower than the average and others are growing faster. And technically speaking, there is divergence in growth rates. In the sense, the richer states are growing faster. But the point still remains that every state's growth has accelerated. That's on the growth side. But we extended that exercise and we also looked at other broader developmental outcomes and access to service. And there is huge convergence across all states. And the same thing comes out, of course, in the NFHS data as well. Our study was started before the latest round of NFHS, and you can pick any indicator for which there is data, be it access to electricity, water, gender outcomes, health and nutrition outcomes. And I'm not talking about absolute numbers here. Here I'm talking about convergence. So huge amount of convergence happening across states. And I can some of this narrative is also about a potential, that if we have the potential to grow at 8 to 10%, what will it take? And I think the narrative was around that all the states will have to grow much faster than they have. Thank you.
I'll add one thing, states have to change their policies a bit also. That is a problem. And if they don't, then the citizens of the state leave. So you see massive migration happening, of the Biharis and Uttar Pradeshis to states like Maharashtra, Gujarat, Kerala. And so ultimately, you see the problem, if the states don't work to solve the problem, then the problem will be solved by the people leaving the states to go to where better jobs exist. So, internal migration is free, so, people will do that.
I had a question.
Basic question regarding regarding the interest rates by the Reserve Bank of India, which are not. So that spread can be narrowed and so that the investment.
No, I'm not sure that the question has multiple layers to it.
Yeah, me here. Mr. Anant, I just wanted to ask you, made a very major point about the oil cap. Of course, the numbers are not known, and you said because of that, the BOP will be looking a bit difficult this year. Could you just sort of talk about it a bit more? And also, you said the global bond indices thing that hasn't really affected the flow of capital into India. So, I mean, your projections. Thank you.
Actually, you already answered my question, which was raised that some states are just not getting enough revenue allocation. So you actually answered it. But I'd like to make a comment here that when the Asiad 82 took place, Maharashtra really pipped that they should get it. The game should be played in Maharashtra. We are the biggest revenue generators. In spite of that, it was given to New Delhi because it's the capital. So I'm just giving this very ancient example of 40 years ago. Whoever is doing the work and earning the revenue, why they should be allocated to somebody else, and then they merrily migrate elsewhere. So.
You said that your conjecture is that since the food prices is driven by mainly vegetables, so that's going to be transitory. But if you look at more deeper into the contributors to food inflation, so it's not only vegetables, it's the contribution of cereals and pulses is also increasing, and which is because of MSP hike. It is in the last budget, it increased by 3 to 5% in many of the goods. So that's not transitory. That's going to be, it will signal the market for higher prices. And also, do you really think is food inflation will be transitory, but or is to my sense is going to be more sticky and it's going to be staying there?
That Mridul takes inflation and monetary policy questions, and Anantha.
Okay, so it's a fact that food has been the major source for inflation in India, but I think we need to understand the nuances a bit better, in the sense that within food also there are elements which are protein rich, or things where the demand matters a lot more than supply, and that is also causing inflation. But the inflation has been caused also because of climatic changes. So you had unseasonal rains which sort of disrupted the whole supply, and engineered food inflation. So my worry is not that much about the food inflation. It requires a structural response, and I think government is doing that in many ways to overall improve the agriculture supply. We are constrained because political consensuses are hard for reforms. We have seen that happen in agriculture. We have seen that happen in labor, where reforms were carried through, but implementation has been tardy. Now, what we also need to be conscious is that the core inflation has been high in India. If you do ex-food at ex-fuel, if one was to see the average before the flexible inflation targeting was introduced in the new index, it was 5.1%. And then in the flexible inflation targeting period, we were able to lower it to 3.6%, but it has gone back to 6.1% post-pandemic. So this is where I would agree that some more tightening is necessary, because we still have real negative policy rates, and that is essentially a repression on the savers, and that would actually widen the current account gap, and it's to some degree reflecting there. So we have to carry the process of completing the monetary policy to disinflate without really being too disruptive of growth.
So on the oil price cap, I wish there is more to say than what I already said. I mean, we have obviously no information, in the sense that we don't know what the absolute number for the price cap is and how it will be implemented. And of course, whatever measures that the Indian government had taken in the first 6 months of the current financial year to ensure adequate oil price supply at good prices, I'm sure these plans are being thought of, and I am not privy to them at the moment. But my only concern is that this oil price cap measure, though the intention is to ensure that insurance and shipping services are available to crude transshipment, unlike the European proposal, which was to completely eliminate those services being available, seems to be a middle path. But the reality could be that this middle path is as bad as the original intention in terms of the supply availability. So there is nothing more for me to add. And the second question you asked about the capital flows, what was?
I was saying that you don't really think the reports about global bond indices and things and others has affected the...
No, that's what. The global bond index inclusion not happening hasn't really affected because there was a 10-20 basis point backup in the yield, but you can't necessarily attribute it to the index inclusion not happening, because simultaneously we have seen the US 10-year bond yield rising as well. So to isolate the effects of that, it is a bond index inclusion, not non-starter being a contributor of 10 basis points, etc. That's difficult to, because there are a lot of entangled effects here. But the truth is, given our credit standing and given the way the bond yield has remained relatively stable over the entire 6 months of the current financial year and through the Fed tightening cycle, etc., I think augurs well. And the market understands, I think, that the overall debt sustainability is not in question, because whether you agree with 5 or 6 or 7% real GDP growth as an average for the next 6-7 years, nominal GDP growth will be of the order of 10 to 12%, and therefore cost of capital being around 6 to to 8%, wider range, sustainability is not a issue to be concerned about. And I think I will just add a caveat to one of Mridul's response. He talked about real rates in India being still negative, but real rates elsewhere are much more negative. So financial repression is far worse elsewhere than in India.
If there are more questions, we can take one last round.
My name is Anant. What challenges do you see in terms of financing of investment in the coming years? Of course, there was mentioned that the investment rate has been going up, which is right, but the presentation itself did not talk too much about investment as such in the investment scenario. So I would like you to just throw some light. Of course, bank credit is going up, which is good, but bank credit is not really, we have been through that phase when banks were financing infrastructure, so probably we are not looking to that. There was talk about asset monetization, but asset monetization is strictly not investment, it's a transfer of asset for better utilization. So in that sense, it should not, in a very accounting sense, it should not lead to investment rates going up, but probably utilizations may improve. So what do you see as the challenges, especially given the international scenario where the interest rates are likely to remain elevated for some time? So how do you see this panning out in the coming years? Maybe Poonam and CEA may like to respond. Thank you.
And then you carry on. I think that's a very important question you asked about the financing landscape of the country. Who's saving, who's investing, and what is the intermediation channel? Absolutely. So, and there are many facets of this issue. There is an issue of, as I said, who's financial intermediating. So banks have been the largest financial intermediaries, and they have not done terribly well in the last few years. And you might be aware of some work that Professor Arvind Panagariya and I have done on ownership of banks, and how in that paper we take a view and we show how public sector banks in particular have not been an efficient or stable intermediary of financial savings. Another issue is besides banks, so a whole lot of, in our view, a whole lot of restructuring is still needed on the ownership side in the banking sector. But outside of banking, there are other intermediaries. There are NBFCs, there is equity market, there's capital market. Equity market has been doing relatively well, but if we look at the debt market, that still needs to be developed, at least the private corporate debt market. So that's in a technical sense the financial intermediaries, but another important question is who's saving and who's using those savings. So you're absolutely right, household financial savings rates have been rather stagnant. A large percentage of that is borrowed by the government. Very little is left for the private sector. So these issues and challenges remain. And for India to grow and to be able to finance investment, at least in the next 2 to 3 years, there is no other way but to import capital. And that's where the question is what kind of capital you import. So you mentioned that the global environment is becoming more challenging because of the policy rate hikes. And there my view is that in order to meet our financing requirements in the next 2 to 3 years' time, FDIs need to be encouraged and increase a whole lot. So which means that you are tackling the issue of limited financial savings as of now. So you're bypassing that. So you're importing stable forms of capital, which have seemed to be quite rewarding in other countries. And alongside, we need to fix our financial intermediation landscape, which is easier said than done. So both banking sector and corporate bond market and long-term finance will need to be fixed meanwhile. So I'll stop here. Anantha.
So I would take a different tack from what Poonam said without necessarily contradicting her, because the primary savings for any system, whether it is the private corporate sector or a macro economy, comes from its internal resource generation, and that comes with growth. So organic generation of savings is the primary source, as it is the case for corporate sector, and that is what we saw happening in the first decade of the millennium, when along with high growth, the savings and investment rates both picked up. So an economy that is continuing to grow will generate its own resources. On top of that, the financial sector reforms facilitating FDI flows, and also the fact that as countries now focus more on supply chain resilience and diversification, and India is coming into the frame in terms of being an investment destination, will also add their own availability of resources to finance our overall infrastructure investment needs, etc. But I would put my hopes on the fact that with the last 4 to 5 years pre-pandemic, where we saw savings rates stagnating or even declining, was entirely because of the overall growth rates being lower because of the financial system repair. The corporate sector balance sheets were also stretched and they were repaired as well. So we should not extrapolate from those 2018 to 2020 trends as the norm. If our average growth rates are 7, or as Dr. Panagariya put it, even better than that, I think the economy will generate its own internal savings. As income rises, savings also will rise. And in fact, I want to supplement one of the points Dr. Panagariya made in response to your earlier question. I just looked at the numbers in dollar terms, not even in rupee terms, because we are accounting for rupee depreciation. In the quarter century between 1993 and 2018, India's dollar GDP went up at a compounded rate of 9.7% per annum.
Could I ask a question? Here, I'm at the back. Hi. So this is about, so Dr. Gupta mentioned the high public debt ratio, debt to GDP ratio. A couple of months ago, we were talking a lot about cutting down, high revenue, unproductive revenue expenditures. So as to, create more fiscal space for capex and more productive expenditure. So is that like a major, a plank of, or a way of, generating space for more productive expenditures going forward, maybe cutting down on some of the schemes that have not been very effective? That's the first question. Second question is I know we are here to discuss the India's economic outlook, but any ideas on China's medium-term economic outlook? I ask because, some of this stuff, I think Ruchir Sharma pointed out, is looking at 2.5% to 3% for in the medium term, and you have the property market situation as well as a population decline, high debt. So yeah, I would love to hear some ideas on China's situation.
Mridul, do you want to take this?
Okay, I'll very briefly take it. I mean, what we are seeing in China is a pronounced slowdown. So part of it is explained by middle income trap, where after robust growth for 3 decades, the growth has to come down. But this is a lot more than just middle income trap. So we are seeing structural problems in the economy. We are seeing macro stability problems in the economy. And that's why, for the Indian context, I may just say, my objective of portraying the global picture was to highlight that what you need today is to preserve macro stability. The growth will come on its own for the Indian economy. So that's the risk we need to keep in mind. But coming back to China, what we are seeing is China would probably grow around 4% in the near term, and that's a significant decline. There are downside risks to that. We are seeing the zero COVID policies lingering even after the party meeting which happened earlier last month. So we are also seeing supply chains pretty much affected on the Chinese freight routes. So the Chinese freight routes are much worse affected than the others. The freight rates are higher there. And there is this fall which is occurring in their manufacturing activity, despite the latest quarter number surprising on the up from the market consensus, but that is just a decimal issue. But we have a more structural problem there. So with the geo-fragmentation, those risks will just go high. I mean, personally, I wish we use our G20 presidency to lower the risks which exist in the de-risk the global economy, because nobody is gaining out of it. But I think the Standalone, what I see is the geofragmentation will grow next year, and that would affect China a lot more. And if any flashpoint occurs near China on the seas or whatever, the repercussions could be just huge in terms of the global trade and the Chinese future. Obviously, a little slowdown is something which will be very good for the Indian economy because commodity prices will adjust, but a deeper problems could affect everyone very badly.
No, answer to the first question, yes.
Okay, since we have exhausted the questions and also our clock has hit exactly 1 o'clock, we are on time, so we'll conclude the session here, and lunch is waiting for all of us.
Thank you very much, everyone.
So thanks all.
And thanks to Anant, Professor Panagariya, for being here. Thank you very much.